This is the daily fiscal pulse for the 13th of August, 2026. What you're looking at is a one-day snapshot that closes out Thursday's activity. Keep in mind this reflects end-of-day positioning, not real-time market conditions. Let's set the stage first. What's actually moving markets today? The dominant theme is no clear dominant narrative. We're seeing headlines around Luigi Mangione pleading guilty in federal case related to United Healthcare CEO killing filter through the market, and that's clearly influencing how traders are positioned. The key is to look past the headline noise and focus on what the actual flows are telling us. So here's what the numbers showed us on the day. Net fiscal transfer landed at $10.7 billion, with tax receipts carrying the bulk of that load at $4.6 billion. Nothing that jumps out immediately, but it's worth tracking where that money is coming from. On the equity side, ES futures closed at 7,823, maintaining its footing above the 20-day moving average which sits at 7,599. The 20-day trading range works out to roughly 493 points. That's meaningful support even as we're dealing with fiscal headwinds pushing in the opposite direction. When you look at the recent cadence, it's been fairly consistent day to day. The 5-day average is running at about $8.8 billion per day, which tracks pretty closely to the 20-day average of $10.5 billion. So far, no sharp pivot in liquidity reaching the financial system. Stack that against last year and the picture becomes clearer. Fiscal year-to-date spending stands at $1,508.3 billion, which represents roughly a 10% decline compared to the same period in 2025. That's a substantial pullback in fiscal stimulus, and it has real implications for how much liquidity is available. If you're thinking about going long ES, that fiscal backdrop deserves consideration. Our conditions gauge is reading -66 right now. That's restrictive. But here's what history shows us. We've encountered similar setups many times over, and even with reduced liquidity, the S&P has averaged roughly positive 1.5% over the subsequent month. Liquidity and price don't always move in lockstep. Markets can still creep higher regardless. There's another factor worth noting though. Leveraged funds have been consistently adding long positions, and margin debt is sitting in the 96th percentile. That's well above normal. Historically, when you see levels like that, it's more of a caution flag than a buy signal. So what does this mean when you're actually trading? With fiscal transfers running below prior year levels, there's less cushion built into the system. When data favors the bulls, price can still work higher methodically. But if a real risk event materializes, like a shift in the no clear dominant narrative, the selling side can accelerate because there's simply less liquidity underneath to catch it. Couple of dates worth circling. The 15th of August marks a Treasury coupon interest payment window with a large reserve add, which typically influences short-term funding flows. The next significant Treasury coupon interest payment window lines up around the 15th of August. Fiscal drag is showing up clearly in the data. That said, the rate of tightening could be stabilizing. What happens next will likely depend on how these upcoming scheduled flows materialize and settle. That's where the opportunity sits at the moment.